tech stocks have actually gotten cheaper compared to 6 months ago because earnings have been so good. If you said this was a real bubble, if you said this is another .com, none of the math lines up with that narrative. Investors do not care that inflation's going up, the job market's starting to show some signs of weakness, economic growth was revised lower last quarter. So all these things, and yet investors keep buying stocks. Something has to give at some point, but for now, I keep saying this all year, AI is the macro.
Welcome to The Big Skinny with Lou Basenese, where we give you one headline, one chart, and one investment insight that you should pay attention to right now. And today, it's my pleasure to be joined once again by Phil Rosen, Chief Market Strategist at ProCap Financial. Welcome back, Phil.
Thank you, Lou, for having me.
Man, always a pleasure. Plenty to whip around. I want to start with Micron, which is a stock that so many people are finally paying attention to. You've been long in it. The top headline today, before we walked in, Yahoo, Micron stock hasn't been this overbought in nearly 30 years. How do you think about that as a long-term shareholder?
You know, they could have been saying that probably at any of the last months in the last 12 months because it's been on this incredible run. I think it's up 900% in the last year.
Wow.
But
where was my tip, dude? You never told me.
Well, you know, I'll give a shout out here. Best Ideas Club. We published Micron in February 2025,
nice.
And it's up more than 1,000% since then. And that was based on an interview I did with Jordy Visser, who is a great investor. And since then, I've been very long Micron. I think that fading it has been the wrong call for the last year, even though you get headlines like this all the time from legacy media saying, look, the price action is so frothy. It looks just like the .com bubble. It looks overbought, whatever metrics they might be measuring. But if you look at the forward earnings, it's trading at 9 or 10x forward earnings. That is ridiculously cheap, cheaper than Oracle, Nvidia, Broadcom, like all the other big players that are getting a lot of headlines in the AI trade right now are way more expensive relative to Micron. So to me, yes, the price action is absurd and eye-watering, but it is so compelling on a forward earnings basis. To me, I think you have to be long this.
So does that give you a lot of anxiety heading into each quarterly report where like, oh man, if they shit the bed here, then the forward earnings multiple is going to, get expanded and now it doesn't look as compelling?
Yeah, look, the chip and memory sector, it's cyclical. We know that through history, but right now the AI trade has so much momentum. It's beginning to look very structural as opposed to cyclical. So yes, the quarterly earnings, sometimes they get jitters around them. And yet the Micron trend has been so ridiculous that it kind of puts me at peace that, okay, look, we're probably going to keep going up for a little bit longer. They're already sold out of all their inventories in the coming year.
Yeah.
I don't know how you build the bear case around this other than looking at the chart. And, I'm not big on technicals or taking a solely chart view on whether to own a company, because if you think about it, you're buying a share of a business, right? The business is exceptional. Leadership is exceptional. The management team has guided very positively for multiple quarters in a row. And the only thing that would break all of this is if they really came out and said, look, we suddenly are oversupplied.
Yeah.
And there is no way we're getting to an oversupply for the AI trade.
Yeah, no, and I think you well summed up on the technicals. That's how I look at it too, is you have to pay attention to them because so many other investors do. But in terms of the full signal, like just relying purely on that, it doesn't make any sense because you're buying into businesses. One more tangent here on this Micron cheap forward valuation relative to Nvidia, right? Nvidia trading at a super cheap forward valuation as well. What do you think the market's waiting for? I mean, why are they so reluctant to re-rate it? It reminds me of Apple back in the day when it like got stuck in like this 20 to 22 forward times multiple, and then it re-rated to like 27 times. You think that same is possible for Micron and Nvidia?
I think part of it is that the financial press has not been a cheerleader for either of these companies. They're pretty bearish generally on AI is what I find, at least the content I'm reading. There's a lot of skepticism around whether AI can last, whether it's going to fulfill its promises as both a technology and also a shareholder value generator. I'm very bullish on both those fronts, but I think because the sentiment has been relatively weak around AI from the financial press, and there's still a lot of bears in the market. All the sentiment surveys still more bearish than bullish. That's probably a big reason why the biggest players of the AI trade are not getting re-rated higher.
Yeah.
And I know, look, Micron's had an incredible run, but because it's so cheap, that's what makes me think once the market starts to realize what it's doing, what it's building, how it's providing for every major player, that re-rating is still on the way, which is why I'm so long Micron.
Yeah, I completely agree. I got in late, but because it's so cheap, and I agree with you. I don't see how you correct this supply-demand imbalance quickly or easily without the stock re-rating. But let's talk about duration, things that people don't think can keep lasting. And that includes this bull market. But you're out with an interesting chart recently in your daily newsletter, which everyone needs to sign up for if they haven't already. Talking about the average length of a bull market, where are we in relation to history and what does that tell you?
So right now, I believe, if my numbers are correct, we're about 1,300 days into a bull market. And that's actually about 600 days shorter than the historical average.
Wow.
So that's
sort of like only 2/3 in.
Exactly. Yeah. And if you look at the bull market and say, look, we're looking like .com, maybe, but even if we're looking like early .com, we're certainly not 1999 end of the bubble.com, at least that's my view. And if you look at this chart, 600 days left to get to just the historical average of what most bull markets tend to do. We're not even at the overextended point. We're not at the point where you should be concerned like, hey, this has been going on too long. The music has been going on too long. It's going to stop soon. So again, this is just one more point, just like with Nvidia and Micron. Things are looking relatively steady, stable, and arguably cheap still, is how I would look at the data. And, the chart is a bit of a, it's kind of a wink and kind of sassy almost, because if you look at this and put it in front of the bears, I'm sure they would have tons of rebuttals that probably make a lot of sense. But to me, I look to history as sort of an indicator for what comes next. I think we're in a pretty good spot as far as even if you want to stop your stock picking and just go into the S&P 500, it's probably a pretty good bet right now, even at all-time highs. Yeah.
So if we kind of entertain the bears for a second, they could dismiss this as just technicals, right? Like technically we've had bigger and longer bull markets, but we don't have this. I think it'd be an interesting chart to show the average duration of bull markets next to the earnings growth expansion. How does that factor in? Because we're coming off of, I believe, the 6th quarter of double-digit earnings growth, revenue growth. The Mag 7, which I think we'll hit on later too, is re-accelerating. So does that underpin your bullishness on this bull market?
The thing I keep pointing to, tech stocks have actually gotten cheaper compared to 6 months ago because earnings have been so good. So that alone should, I think, put the bear case to rest, at least for now. When new data comes in, I can change my mind on that because I think that's, you have to with how fast markets move. But if we look at the earnings data right now in the last couple quarters, they have been accelerating with the price action. So it's not even that prices have outrun earnings. It's almost the opposite for a lot of these major companies. And that's so interesting because it deflates the bubble narrative. If you said this was a real bubble, if you said this is another .com, none of the math lines up with that narrative. And I think it's really easy to point to extreme price action and say, this is just like XYZ time in history.
Right.
But no one ever does that with earnings. So you could say, hey, we've never had earnings grow this fast or look this robust at any point in history, but no one wants to make that comparison.
Yeah, because you said it earlier, when you buy a stock, you're actually buying ownership in the income and profit producing power of that. And if it keeps going up, the value of that stock should keep going up. All right, so let's talk about if you just index and said I don't know where this is going to stop, I can ride this out, but you don't have to do that. There's pockets of opportunity undervalued. You think chips and memory specifically could be an opportunity. Last time we talked, EWY was one of your favorite ways to play it. But now you think SMH could be a compelling way too. So give us the pros, cons, what does each do and not do?
So to be clear, I still own EWY. It's the South Korea ETF that is pretty much all Samsung and SK Hynix, which is part of that chip and high bandwidth memory trade. I'm very bullish on that, but it's extremely concentrated. One, in high bandwidth memory, but two, it's two companies that make up 50% of the ETF.
Right. So it's the only way to trade them easily on a US exchange, right?
Totally. So it's great exposure if you're very high conviction on those two companies and generally the memory trade, which is what Micron is as well. But I'm actually contemplating as we speak, starting to take profits on that trade because I've been in it for a couple of years. I've done very well, specifically in Korea.
Yeah.
But I'm getting slightly nervous that I'm seeing it pop up more and more across headlines, different conversations. I have a lot of friends messaging me about Korean stocks right now, which to me, could be a top signal. Who knows? So to me, SMH might be the next. It might be a cooler trade. It might be a smarter trade just because it's more diversified.
Yeah.
And you get the similar memory and chip exposure. Micron is in that, Nvidia is in that, but you sort of come out of South Korea. But I still think it's pretty high conviction just based on what I believe the AI trade is and how much longer we have to go.
How many positions are in SMH offhand roughly compared to EWI?
Good question. I don't have it in front of me.
Yeah. I don't know it either, so I'm just as guilty.
But all the major AI players are in it. I mean, if you just look at Nvidia and Micron alone, I think those are the two biggest, if not two of the top four biggest holdings. So to me, that gives me a lot of confidence that ETF will continue to do very well. But the reason I'm thinking about rotating out of EWI into SMH is for that diversification.
Yeah.
Even though if you look at SMH, you can still say this is a very concentrated bet on a single theme, which, if you're bullish on the theme, I think it makes a lot of sense.
Yeah. No, I would tell you though, and there was only one other individual who I know has been a lifelong contrarian that ever talked about EWI. And now I feel like it's popping up everywhere. So I think you're right on the sentiment side of things for sure. So we'll see how SMH works out. But
I'm confident.
If you haven't noticed, we're all about all filling, zero fluff. And so is our email newsletter where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Before we run, I want to talk through a couple just quick hitting things. We kind of put a finger on it before, Mag 7 versus what I'll call the Lag 7, right? That had been the preponderance of evidence, is that the Mag 7 was outperforming everyone and the unmagnificent 493 were lagging. What's going on now?
This is the most surprising stat that I've seen recently. The equal weight S&P 500 is actually outperforming the Magnificent 7 this year. So I believe the equal weight, last I checked, is up about 8%, 9%. Yeah. And then the Mag 7, if we take the Roundhill Mags ETF, I think it's up only 6.5%, 7%.
Yeah.
So another way to frame that, the average stock in the index is outperforming the average Magnificent 7 stock, which is totally a narrative violation because a lot of people point to the market being so top heavy, tech heavy, concentrated, narrow, whatever. But really, breadth has been strong enough for these average companies to outperform these trillion-dollar giants.
Yeah, which is healthy, getting back to earlier about the bull market lasting much longer than people think, because it's not just a handful of stocks that are driving it.
Yes, and I think that's the narrative violation that people aren't really acknowledging, because everyone wants to say it's a bubble, this is an Nvidia-driven market. That's not really the case.
So let's move from narrative violation to model violation. SpaceX IPO coming imminently. Looks like it's going to get incorporated to a lot of indexes. Some would say prematurely. Some would say, beneficially to Elon Musk. What do you think of the IPO? What do you think, reactions look like? And is it a long-term position potentially?
I wouldn't be buying it with the IPO. Pretty much everyone you can think of already owns it. Every fund, every major investor, every private investor has been in SpaceX for a very long time. When it comes to public markets, it's probably going to be a trap for retail. Yeah. They're going to come in, probably get burned pretty bad in the early days. Down the line, I love Elon Musk. I'm very bullish on what he's able to do as an operator, entrepreneur. And I'm sure he'll make SpaceX a success as a public company. So maybe down the line, I would buy into it depending on how the valuation shapes up. But generally, I think the story around SpaceX is so interesting because you have the indexes negotiating essentially whether to put it as part of the S&P 500 or whatever. And one way to think about it is that Elon Musk, richest man in the world, has essentially strong-armed implicitly these indexes saying, hey, this is coming to market, so change your rules for him, essentially, which I think on one hand makes total sense. There's a reason that he's found the success he has because he's contrarian. He's someone worth betting on. He makes a lot of shareholder value. That all makes sense. But then the other math reason is that if it hits 2 trillion valuation on day one, how could it not be included in these major indexes? Because then if it runs at a true 2 trillion valuation, so let's say 3 trillion, 4 trillion, everyone in the S&P 500 is going to want exposure to a company like that.
Yeah.
But if the indexes don't include it, then retail gets screwed on that side too.
Yeah, no, it's a conundrum for sure. So I think it's playing out the way it needs to maintain market balance. I read through the S1. I don't know if you've combed through some of it. Some really interesting tidbits in there. What was something that stood out to you? And I can share one from my side.
I mean, I think the one that made the most headlines is that Elon pretty much says this has a $30 trillion addressable market because it's like the universe or what is the galaxy is the addressable market. So again, that's pretty funny. And you could also see they have a bunch of moonshot bets that are literally on the moon. They're trying to establish the colony. And I'm sure one thing that's going to come up increasingly in the coming year or two is that governments will want exposure or buy-in with SpaceX to help establish colonization on the moon as well. So I think that's an interesting play. Not as many people are talking about. It's like just because SpaceX wants to be on the moon, that is going to usher in a sort of demand cycle for governments to want to establish positions on the moon through SpaceX.
Yeah, mine was related to that, is that for him to earn a big chunk of his equity, he has to put 1 million people on the moon or Mars. I can't remember which one it is, but crazy for him to be like, yeah, I'll take that as a performance incentive. And I think I can do it. Moving away from extraterrestrial to more terrestrial, war in Iran headlines, oil headlines. Where do you think, as you kind of survey really big experts on all sides here, does oil get back below, into the 70s or does it go to 150? What's your sense of where people are kind of handicapping that move?
It's really hard to say because the peace deal, no peace deal headlines, we pretty much get new ones every day. And that will really determine the price of oil long-term, even short-term. To me, I think the more interesting thing is that it almost doesn't matter what happens with oil, what happens with inflation, what happens with gas prices, because investors are so fixated on the AI trade that all these economic indicators that are typically very negative macro signals have pretty much had no impact on asset prices. And I think the reason for that is this AI enthusiasm. So we have a really interesting mosaic here because one, you have still a lot of bearish financial press on the AI trade. Two, you have all these IPOs come to market that are, the biggest companies we've ever seen that are capitalizing on the AI trade. But three, you have pretty much a stagflationary macro backdrop with the Iran conflict. So all these things, and yet stocks are at a record high. Investors do not care that inflation's going up. The job market's starting to show some signs of weakness. Economic growth was revised lower last quarter. Yeah. So all these things, and yet investors keep buying stocks. Something has to give at some point. But for now, I keep saying this all year, AI is the macro, and the old valuation metrics or the old macro metrics that we would typically use are just second or third tier variables at this point.
It's a good way to put saying it's different this time without saying it's different this time, because then you get screwed. You kind of touched on it too, and I think this is interesting. You wrote a piece recently about gas prices. The pain at the pump is not directly correlated to S&P 500 returns. So is this, in relation to your last point, just proof positive that the economy and the stock market are two different things and they can move in completely different directions?
This idea of the K-shaped economy has really gained traction in the last couple of years, and for good reason. You have investors and asset allocators living in one world, and you have essentially everyday consumers living in another. And I think it's not as new of a phenomenon as we might think, because even if we go back through the last 50 years of data, we had this great report from ProCap Insights, which you're referencing here. Gas prices have had zero correlation to S&P 500 forward 12-month returns. So right now, people are saying gas prices are so high, energy prices are high due to the Iran conflict. This is going to trickle down into consumers, maybe earnings, company profits, all these things. But that's actually not what the data shows historically. So to me, it's not good or bad that high gas prices mean nothing for the stock market. That's just what the data shows. And maybe if it was a more equitable world, there would be some type of correlation. That's just not what we're seeing in the data. And when people say, look, gas prices are going up, so it's an economic red flag, maybe, right? It's possible.
To be determined,
Yeah, it's a certainly consumer pain point, but using that to determine what you're doing with your portfolio, I think is a critical error.
Yeah, I love it. You're saying you're data driven. And in fact, your new position with ProCap Financial is completely data driven. I want you to tell people, like, what's one of the most surprising things you're finding out from the data in your completely AI agent driven research company that's, offering subscriptions now?
Yeah, it's a good question. I do learn things every single day from these AI systems and the AI agents that we're deploying to create investment research. One of the things that it's really good at is sort of piling catalysts on top of each other. So one, it's like maybe S&P 500, best 2-month stretch we've ever seen. We just are coming off, I think it's a top 5 stretch ever.
Yeah.
You can pile that on top of gas prices, on top of geopolitical conflict, and then on top of like earning strength. Put all those variables into the system and say, now find me the 2 best stocks that benefit from all of these combined.
That's wild.
So that's extremely difficult to do. But with our systems, we could come up with very interesting ideas through this process. And if you took a team of, let's say, human analysts, that'd be a very challenging task to ask them to do.
Not let alone time consuming, right?
Very time consuming, and time consuming to even investigate one variable, let alone 5 stacked on top of each other where they all overlap. So I think that's what has been the most surprising thing that I've been able to execute on and learn from every day, is just finding these interesting ideas that come from stacking all these different variables that ordinarily you pretty much wouldn't be able to.
Yeah.
That's a lot of fun for me. And also the unique thing here is that I believe we're the only agentic investment research shop right now that's producing high volume, high quality institutional grade research. And that is only possible because of AI.
Yeah.
And this gets right to the most common pain point of the economy these days, which is AI taking jobs. So it's an interesting place to be operating at.
So I have a question related to that, because I was curious. Like, I would say a lot of people right now that are bearish or negative on AI don't use it that much. So that I'm curious, what's the reception for 100% agentic stock research? And is there resistance likely to be just converted once you have a track record, right? Because you launched this a couple months ago. 12 months ago, if it's undeniable, the data, how do you feel? Like, what's the initial reception you've gotten, and how do you like incorporate that into your long-term vision for the company?
Our current subscribers have loved it.
Yeah.
And I've certainly learned a lot from it. Personally, I'm biased, of course, but the unique thing about this offering is that we can generate essentially deep dive research about breaking news. So I don't think there's any other offering like that in the market. And, if the other night Berkshire Hathaway acquired a pretty big home builder, we can generate a report on that moment of and have it out to subscribers immediately and, build some sort of thesis around either Berkshire or the new company, whatever it might be. That's just an example. So the response has been overwhelmingly positive. I think the cautionary tale of any new technology coming to market is that, are you too early for people to be ready for it, or people to be bullish on it, as bullish as you are? I don't think we are, because AI is dominating the world right now. And I think people are waking up to that more and more. And 2, I think the product is just really strong, and we believe in the product. And I think the research, I believe our subscribers would agree that it speaks for itself as far as the rigor, the sourcing, the data, and also like I think it's compelling to read as well. So I think that's, there's all these different things at play here.
I agree. I'm on the side of the camp with you that it's a solution that's not in search of a problem. It's actually solving a problem that's out there, like being able to do deep dive research in a way that other people can't. So where can everyone find these insights and find your insights on the regular?
So you can go to procapinsights.com. We're publishing reports there every single day. And my Twitter handle is just Phil Rosen, 2 N's at the end. I post a lot of charts and video and other shows like that. So that's where I am. Easy to find online.
Always a pleasure. Next time, I'm going to be curious if Berkshire buying Taylor Morrison is a contrarian signal to get back into housing. So maybe one of the agents can get onto that. I don't know.
I'm going to put them to the task.
Always a pleasure, man. Thanks for coming again.
Thank you, Lou.